Hey guys, welcome to the iptaX Foundations, and today for our educational video we'll be learning about the PD array matrix. Alright, so just for an overview, these are the topics that we'll be discussing today. So first of all, we're going to be discussing what a dealing range is, and then secondly, we'll take a look at what is premium and discount, and then we'll take a look at what is a PD array, and then finally we'll close by learning how to use the PD arrays. Alright, so let's get into it. Alright, what is a dealing range? So a dealing range is a range that is created after the sweep of both buy-side and sell-side liquidity. And then I have that price moves from external range liquidity to external range liquidity to internal range liquidity and finally back to external range liquidity. External range liquidity is the high or the low of the range, and internal range liquidity is the liquidity that is inside of the range. So I know that that was a mouthful, but let's dissect everything just so that you guys can understand. So first I have that a dealing range is a range that is created after the sweep of both buy-side and sell-side liquidity. So when I say range, that is different than what a dealing range is. So in my terminology, when I say range, I mean something totally different than a dealing range. So a range is just from a high to a low like this, or from a low to a high like that. So that's just a range. But a dealing range is a sweep of both buy-side and sell-side liquidity. So above every high, there is buy-side liquidity. Or sorry, above every swing high, there's buy-side liquidity, right? So we have a swing high right here. And then below every swing low, there is sell-side liquidity. So in this example, we see that we take buy-side liquidity and then we take sell-side liquidity. So after that happens, we have a dealing range being created. And there's two types of dealing ranges. There's a bearish dealing range and a bullish dealing range. So a bearish dealing range is when we first sweep buy-side liquidity and then sell-side liquidity. Like in this example, we take buy-side first and then we take sell-side. So this is a bearish dealing range. And then inversely, a bullish dealing range would be when we take sell-side liquidity first and then buy-side liquidity. So that's what a dealing range is. And then next I have that price moves from external range liquidity to external range liquidity to internal range liquidity and finally back to external range liquidity. So that's basically just the anatomy of a dealing range. So this is the range, right? We have a high and a low, and above that high there's external range liquidity. So buy side and sell side liquidity is just external range liquidity. You can think about it that way. So we take out that external range liquidity here, and then we take out external range liquidity again, and then we come back inside of the range, and then we take out internal range liquidity, and then we see that we exit at external range liquidity here. You can't see it in this picture, but this price chart actually does come down below this low. But just to clarify what a dealing range is, I just have the picture cropped up to this. So yeah, so that's the anatomy of a dealing range. That's when we take external range liquidity and then external range liquidity again, and then we come back in for internal range liquidity, and then we exit at external range liquidity. There is a bit more of an advancement to dealing ranges, but since we're all just starting off and we're learning the basics of price action, this explanation will do for now, and then I'll help you guys understand the more advanced concepts about dealing ranges later on. All right, and then I already covered this, but that's basically external range liquidity is above the swing highs or the lows of the range, and then internal range liquidity is inside of the range. So yeah, so that's what a dealing range is. So now let's take a look at what premium and discount is. All right, so what is premium and discount? The upper half of a range is premium, and the lower half of the range is discount. And the midpoint of the range is known as equilibrium. So as you can see in this example, we have, this dealing range from this high down to this low. And then that upper 50% is going to be your premium range. And then that lower 50% is going to be your discount. And then that midpoint right there is going to be equilibrium. All right, and then the premium end of the range offers the most ideal selling opportunities. And then the discount end of the range offers the most ideal buying opportunities. So that's pretty self-explanatory, So if you were wanting to buy something, you would want to buy something at a cheaper price. That way you can make more money on the way up. And then inversely, when you're selling something, you want to sell something at the most premium price. That way you can make more money on the way down. So that's why the most ideal selling opportunities happen at premium, and then the most ideal buying opportunities happen at a discount. And the second best buying opportunities will happen at equilibrium, and then the second best selling opportunities will happen at equilibrium as well. And that's just kind of where price is fairly valued. So that's like the fair value of a range would be that equilibrium. So it's not premium, or a discount, but it's just at a good price, and that's equilibrium. But that's not the most ideal place to sell or buy. So if you want to be selling, you want to sell at a premium, and then when you're buying, you want to buy from a discount. All right, so now let's take a look at what the actual PD arrays are. All right, so PD array stands for premium or discount array. And PD arrays are the signatures in price that have the likelihood to cause a change in the state of delivery. Now, as I've already mentioned in the previous teachings, we know that the markets are not random. So when price is moving, it's always moving from a logical level to another logical level. And these logical levels that price is always moving to and from are called the PD arrays. So let me just draw this out for you guys so that way you have a visual example. So let's imagine that price is coming down like this. Right? So that's when, price is coming down, we're bearish. And then let's imagine that all of a sudden price starts coming up. All right, so we know that the markets are not random. We know that price isn't random. So when price is coming down like this, it's reaching for something, right? And then after it reaches for that and it gets what it wants, it'll start going the other way. And the area, so from here, we see that prices are coming lower, right? So we're bearish. And then something is happening right here that causes price to change its state of delivery and then go higher, right? So from here on this side, we see that price is being delivered bearishly, and then it hits something here, and then that causes price to change its state of delivery and then start moving up or delivering bullish prices. So the areas where price changes its state of delivery are called the PD arrays. And as I mentioned earlier, price isn't random, so it needs to go to these logical levels before it can reverse. And actually, if we're being specific, the PD arrays are the only places where price will actually reverse like this. So what are the PD arrays? Well, the PD arrays are old highs or lows, rejection blocks, bearish order blocks, fair value gaps, liquidity voids, bearish breakers, and bearish mitigation blocks. So those are the premium arrays. And then we have the discount arrays, which are the bullish mitigation block, the bullish breaker, the liquidity void, the fair value gap, the bullish order block, the rejection block, and then we have old high or low again. So we'll go take a look at all of these PD arrays in depth. So let's take a look at what the bullish mitigation block would look like first. All right, so the bullish mitigation block is also known as the failure swing. So that's when we have a low, and then we have a higher low, and then we see that price breaks market structure and then goes higher. And then this high that's in between these two higher lows is called your bullish mitigation block. So as you see here, we have a low here, and then we have a higher low, and then we see that high in between right here, and then we see that price breaks market structure here and then goes higher, and then price comes back down, mitigates off of this mitigation block, and then it goes higher. So that's what a bullish mitigation block would look like. All right, and now let's take a look at what the bearish mitigation block is. All right, so a bearish mitigation block is a low and then a lower low, and then we have, a high, a lower high, and then that low in between those two the low between the two lower highs is your bearish mitigation block. So as you guys can see here, we have a high, we have a low, and then we have a lower high, and then price comes down, it breaks market structure, and then price returns back down to this low, and then price sells off. So as you can see, price came up here, and then it completely reversed from there, right? It changes its state of delivery, and then it comes lower off of this mitigation block. All right, so let's take a look at the breaker blocks. All right, so similarly to the mitigation blocks, breakers are a high and then a higher high, and then that low in between those two higher highs is considered your bearish breaker. So for a mitigation block, we would have a high and then a lower high, but for a bearish breaker, we have a high and then a higher high, and then we have that low in between. So that's your bearish breaker. All right, and then inversely, for a bullish breaker, you have a low, and then you have a lower low, and then that high in between those two lower lows is considered your bullish breaker. And then in this crude depiction, we see that price comes up, breaks market structure, comes back down, it hits that breaker, and then price starts going back up. So in this example, we see that this breaker has a fair value gap as well, and we'll take a look at fair value gaps later, but just to explain why it's there, just know that when we see a fair value gap in front of a breaker, that heightens the probability of that breaker working. So if we were trying to sell and we see a breaker with a fair value gap, that would be a high probability breaker to go short from. And similarly, if we were trying to be long, then we see a breaker with a fair value gap, a bullish breaker with a fair value gap, then that would be a very high probability area to buy from. So yeah, so that's what the breakers are. And now let's take a look at fair value gaps. All right, so a fair value gap is this pattern in price where we have a high of the first candle. So a fair value gap is a 3-candle formation, right? So you have candle number 1, you have candle number 2, and then you have candle number 3 right here. And then a fair value gap is formed when the wick of price number 1 doesn't touch the wick of price number 3, or when the upper wick of price of candle number 1 doesn't touch the lower wick of candle number 3. That's when a fair value gap is created. So as you guys can see here, the top wick of candle number 1 doesn't overlap with the bottom wick of candle number 3. So therefore, we have a fair value gap being created. And the logic surrounding a fair value gap is that the algorithm is offering only one-sided price delivery. So in this example, price is only being offered bullishly. So the algorithm wants to rebalance price and then offer, some sell side in that gap. So price will come back down before going back up. So As you can see in this example, price actually overshoots this fair value gap, but just know that it's okay if price wicks below or above a fair value gap, but as long as the bodies of the candle respect the fair value gap, then we know that it's still valid. So as you can see here, the bodies of these candles still close at or above this fair value gap. So this fair value gap hasn't been negated, and then price makes one more run through that, and then the bodies of that candle still respect it, and then price moves higher. And then we also have another fair value gap here. So if this is candle number 1 right here, this black candle, and then this big white candle here is candle number 2, and this is candle number 3, we see that the upper wick of candle number 1 doesn't touch the lower wick of candle number 3. So therefore, this area right here where the wicks don't overlap is your fair value gap. Just for extra practice, you can see that we have a fair value gap there as well. I didn't highlight that, but you can see the reaction that we typically get from fair value gaps, as I mentioned right here. So yeah, so those are fair value gaps. And now let's take a look at liquidity voids. So liquidity voids are just multiple fair value gaps. So as you can see here, candle number 1, candle number 2, and then candle number 3, you can see that the low of candle number 1 doesn't overlap with the high of candle number 3. Therefore, we have a fair value gap here. And then we also have another fair value gap. So this black candle here, the low of that candle doesn't overlap with the high of this white candle right here. So we have this massive fair value gap right here. And then those two fair value gaps combined, those two fair value gaps back to back would constitute a liquidity void. And then as you can see here, price goes up, it hits that upper part of this liquidity void, and then price changes its state of delivery and then starts coming lower. So that's liquidity voids. And now let's take a look at order blocks. All right, so an order block is either a candle or a series of down closed candles prior to a displacement higher, or a candle or series of up closed candles prior to a displacement lower. So that's basically the bullish and the bearish order blocks. So the bullish order block would be your series of down closed candles prior to a displacement higher. And then your bearish order block would be a series of up closed candles prior to a displacement lower. So as you can see here, we have these two up closed candles, and then we see this massive move lower, and then we see that price comes back up. It hits that order block right here, the series of two up closed candles before the move lower. It mitigates that order block right here. It hits that order block, and then we see that price comes lower as a result of hitting that order block. And then similarly, as you can see, we have this down closed candle before this massive displacement higher, and then price comes lower. It hits that order block right here, and then price goes higher as a result of hitting that order block. So in future videos, we are going to look at more advanced ways of looking at order blocks and how we trade order blocks at IBTAX. But for now, this explanation will do. So just, as a practice, go into your own charts and then look for order blocks. Like look at the last places where price, formed an up close or a down close candle before a big move. And then notice the reactions that price has once it hits those price levels again. So, just do your homework on that. And then, once we start, looking at other stuff, and once we start getting deeper into the teachings, we'll refine, our definition of an order block, and then we'll learn how to use its advancement. But for now, just be content with this explanation, and then, just do your practice and look for them in the charts. All right, so that's order blocks. And now let's take a look at rejection blocks. So rejection blocks are simply just the long upper wicks of a high or the long lower wicks of a low. So as you can see in this example, this up close candle has a long wick right there, and then price hits that wick, and then it comes lower. And then in the inverse example, for a bullish rejection block, this would be a bearish rejection block, and then this is a bullish rejection block. You can see that this black candle right here has a long wick right there, and then we see that price comes and hits that level right there, and then price starts to climb higher. And one more thing that I will add for rejection block is that we want to see the bodies of these two candles be even. So as we see here, we have the body of this candle, the upper body of this candle, and the upper body of this candle is even. So that kind of heightens the probability of this rejection block. And then we also see that the lower body of this green candle and the lower body of this black candle are even. So that heightens the probability of this rejection block as well. So price comes down, hits that wick right here, and then it climbs higher. All right, so that's what rejection blocks are. And then finally, old highs and old lows. So as I mentioned earlier, above every high, there's buy-side liquidity, and then below every low, there is sell-side liquidity. And in order for price to go higher, smart money needs to buy from the willing sellers below the lows. And in order for price to go lower, smart money needs to sell to willing buyers above old highs. So let's take a look at what that looks like on the charts. So just for the sake of laying a foundation, just know that below lows, there's people in the markets that are willing to sell below those lows. So they have what's known as sell stops resting below those lows. And when price comes below the lows, it'll trip them short into the markets. And when you're selling something, somebody needs to be buying it from you. So the counterparty to their shorts is going to be smart money's longs. So smart money will deliberately take price below old lows. That way they can pair up their orders with other traders in the market or other entities in the market, and then they will go long from there. And we know that smart money are the only true entities that can actually manipulate price and make it go either higher or lower. So they price in all of their orders here, and then they take the markets higher. And then right here in the opposite example, we see that price goes above this high right here. Smart money does their order pairing. So above the highs, there's willing buyers who have their buy stops here. And then now they're tripped in long because smart money is selling to them. And then smart money prices in their short orders here. And then that causes the market to go lower. So that's just an example of how highs and lows can serve as places for price to change its state of delivery as well. So I know that this video is very loaded, it's very complicated, and for beginner traders, it's going to be, really complicated to understand at first. So I encourage you guys to, really watch this video over and over again, and then try to look for these signatures in price, and then, make sure that, you guys post your examples in the group as well. That way, I can correct you guys, and that way we can learn. But just go to your charts and then, look for these signatures in price, and then see what price does as a result of hitting those signatures or those PD arrays. So yeah, so this is the video on PD arrays. I hope you guys enjoyed. Make sure, to study, take notes, and practice, and then I'll talk to you guys in the next video. Cheers.